Assalamualaikum, my name is Khairunisa Sofia binti Khairuddin. My number matric is 063823F1016. Today I'm going to present about problem case number 2. First, let's start with the question for the case number 2. You are one of 3 partners in a firm of accountants. 5 years ago, the firm was appointed as external accountant to a successful and fast-growing startup company, engaged to prepare year-end account and tax return. The business had started trading with a handful of employees, but now has a workforce of 200, while remaining below the size of a company requiring a statutory audit. Due to your close relationship with the directors of the company, who are its owner, and several of its staff, you became aware that staff purchase of goods manufactured by the company are authorized by production manager and then processed outside the accounting system. The proceeds from this sale are used to fund the firm's Christmas party.
First, let's take a look at the ethical problem for this case. Some of the employee and management of the company are selling company's goods without recording the sale in the accounting system. The money is being used to pay for the company's Christmas party. This means the company financial records are incomplete and misleading, which is dishonest and goes against proper accounting practices. Accountants also have a close relationship with the company director as the external accountant. This makes it hard for the accountant to stay objective and make the right professional decision because of personal relationship will influence judgment. So the ethical problem involve unrecorded transaction and a conflict of interest which treat integrity, objectivity and professionalism as an accountant. Next, there are 4 affected parties in this case. The first one is the accounting firm. The professional reputation and independence are at risk. If accountant ignore the unrecorded sale, the firm could be seen as supporting unethical or even illegal practices. The second one is the director and management. They are responsible for allowing or ignoring the unrecorded sale. If the issue is discovered, they could face legal or disciplinary action for providing misleading financial information. The third one is the employees. Some employees are involved in the off-record sales, possibly without realizing the full consequences. They could face penalties or lose their job if the issue is exposed. The last one is the company's shareholders and investors. They rely on accurate financial statement to make decisions. Incomplete record mean they are being misled about the company's true performance. Next, let's move to the fundamental principle. The first one is integrity. Integrity must be honest and truthful in all professional work. Allowing unrecorded sale means the financial statement will be misleading, which against the principle of integrity. As an accountant, they should not be involved in preparing or approving any false or incomplete record. The second one is objectivity. If accountants have a close relationship with the company's director, professional judgment could be influenced by personal feeling or loyalty. Accountant must stay objective and make decisions based on fact and ethics, not personal connection. The third one is professional behavior. Comply with law and regulation and avoid any action that could harm reputation or the profession. Ignoring the unrecorded sale would be seen as unethical and could damage public trust in accountant. The fourth one is professional competence and due care. Ensure that all company transactions, including the sale made by employees, are properly recorded in the accounting system. Failing to take action or overlooking this issue would show a lack of professional care and would lead to misleading financial statement. The last one is confidentiality. Protect all information about the client and not share it with others unless accountants have permission or are required by law. Even if accountant discover unrecorded sale, accountant can't just tell outsider about it. Accountant should handle the issue professionally and confidentially by discussing it with director or the firm partners first. Next, we will talk about key consideration. There are 4 key considerations in this case. The first one is the seriousness of the issue. The unrecorded sale means the company's financial statements are not accurate or complete. This could be considered unethical or even illegal, especially if it affects tax or profit. The second one is professional responsibilities. Accountants are responsible for ensuring that the financial information they prepare or review give a true and fair view. Accountant must act with integrity, objectivity, and professionalism at all times. The third one is relationship with the directors. If accountants have a close relationship with the company's director, they may be careful that personal connection not affect professional judgment and must remain independent and unbiased. The last one is possible threat to independence. This can be related to familiarity traits or self-interest trait because of the personal tie with companies. This trait can make it harder to act objectively. We will talk about optional solution. The first one is talk to the company director. The first step is to have an honest conversation with the director. You can explain that all sales, even those made by employees, must be recorded properly in the accounting system. This helps ensure the financial statements are accurate and in line with accounting standard. The second one is suggest strong internal control. Accountant can recommend that the company improve its internal control system so that all sales go through the proper approval and recording process. The third one is discuss the issue within accounting firm. It's a good idea if inform the partners or the firm ethics committee about what is happening. They can guide you on the right professional step to take. The last one is withdraw from the engagement. If the company still refuses to correct the problem, the final option is to step away from the engagement. This protects the reputation and independence as an accountant. The best solution for this case is to first discuss the issue directly with the company's directors, which was the option for number 1. This is the most appropriate first step because it allows accountants to handle the situation professionally and respectfully, while giving the directors a fair chance to correct their mistake. By speaking to them, accountant can explain that all company sales must be properly recorded in the accounting system to ensure the financial statement show a true and fair view. Accountant can also remind them that unrecorded sale could lead to legal issue and damage the company's reputation. This approach maintains a good working relationship and shows that accountants are trying to help the company act ethically rather than immediately taking harsh action. If the director responds positively, the problem can be solved quickly and internally. However, if the director ignores the advice or refuse to take corrective action, then accountant should move to the next step, such as reporting the issue within the firm to protect the personal integrity. Lastly is about the conclusion of this case. This case highlights the importance of maintaining integrity, objectivity, professional behavior, professional competence and due care, and confidentiality in accounting practice. As an external accountant, it is crucial to ensure all transactions are properly recorded to present true and fair financial statement. By addressing the issue with the directors professionally, the accountant uphold ethical standard while giving the company an opportunity to correct its mistake. This approach not only protects the firm's reputation but also reinforces trust and accountability in the profession. That's all from me. Thank you.